Before we start this video, do like and subscribe to our channel and not miss on any updates.
What are the various types of risk that an organization faces? Primarily, there are 4 types of risk that an organization faces. The first one is strategic risk. The second one is finance risk. Third one is operational risk, and the fourth one is the compliance risk. What is strategic risk? Strategic risk is the risk that your existing strategy will no longer work. It may not work due to changes in technology, changes in environment, changes in new competitors coming in, or changes in customer preferences. It could due to be any reason. Second risk is finance risk. What is finance risk? Finance risk again can be subdivided into multiple parts. The first one is liquidity risk. Liquidity risk is the risk that you do not have enough liquidity to meet your obligations. Then you have interest rate risk. You may have loans or you may have deposits. On both of them, you may, because of the change in interest rates, floating rates or fixed rates, you may not receive the value that you're supposed to receive. You may receive less, or you may have to pay more than what you're supposed to pay. So that kind of risk is called interest rate risk. Then you have currency risk, the risk that your existing payments that you have to make in foreign currency or the receipts that you have to receive because of exports, the value decreases. Export value decreases or import value increases, or the value of the investments you have made outside the country, the value of that decreases because of change in currency rates. Then you have a risk that which is called political risk. Let's say you have operations outside the country. Due to change in regulations in that particular country, like prohibition on repatriation, the capitalization, so on and so forth, there may be a case where you may be exposed to risk of your investment. And finally, you have counterparty risk or credit risk. This is about a person or some entity who may not pay up. Someone who is due to you is not paying you due to any reason whatsoever. So that is counterparty or credit risk. Then we have discussed about strategic risk and we have discussed about finance risk. Then coming to your operational risk, it is because the risk arising due to operations. So you have entities that work in, let's say, manufacturing industry, operations heavy businesses, or even in service sector where you are heavy operations. Those kind of organizations where there are risk inherent in the business, like you run a factory, there could be an accident. So these are all operational risk. And the last one is compliance risk. What is compliance risk? It is the risk that you do not comply with the required rule or regulation, or there is a sudden change in the rule or regulation which leads to non-compliance. It could be filing of returns, it could be meeting certain standards, it could be anything. So you can be exposed to compliance risk as well. So these are the 4 types of risk that you should always be aware about. What are indicators of counterparty risk and how can it be managed? Counterparty risk is the risk of some debtor not paying up to you on time. Someone who's due money to you is not paying up on time. What are the hints for this, or what are the red flags? Someone who's taking up more projects than what they can do. Someone who's suddenly doing a lot of business. Someone who has past history of insolvency. Someone against whom some government action has been taken. Someone who's politically exposed. These are all hints. These are all hints that can indicate some kind of a counterparty risk. What should be the measures that you should take in order to mitigate? Mitigate means counter this counterparty risk. You should do enough due diligence. You should do enough background checks. Then you should also go into details of what is the past history of this particular person. Then you should ensure that you're not exposed to a large extent to one single person. You should always have multiple people with whom you deal with. Then you should do a risk assessment and have risk limits on each of the counterparties. If at all there is a negative event, you should take very, very rapid action on what are the next steps that you will do in order to mitigate this risk. If you take these kind of measures to a large extent, you'll be able to mitigate the counterparty risk. What are the indications of political risk? There could be issues of nationalization, there could be economic instability, there could be political instability, there could be restrictions on foreign and so forth. Those are all typically the indicators of political risk. How do you counter this political risk? You enter with local joint ventures, you make borrowings in local currency from nations, then you have good network, you have good relationship with the regulators, you follow the macroeconomic data, then you involve multilateral agencies, you have connects with the local embassies. So you do a variety of things to ensure that you always are assessing this political risk and are always ready to take relevant measures that are required to handle the political risk if any arises. What are indicators of interest rate risk? The risk that interest rate could change, either go high or go low, or there will be a sudden change in interest rates. Things like macroeconomic data. You follow the data and you look at macroeconomic indicators, it will give you an indication as to what is happening to the economy and which way interest rates are headed. Same way you follow the inflation data, you follow the commentary of the local central bank or the RBI, you follow information about GDP and national income, then you are aware of fiscal policy. Some of these are lead indicators and some of them could be coincidental or lag indicators. What are the factors to identify currency risk, or how do you identify currency risk? If there is government action like, there's something like Brexit or anything like that that could lead to potential run on the currency, then you're also aware of interest rates and inflation rates. If the interest rates are fairly high, then your currency will depreciate. Same way, if inflation is galloping away, then interest rates may be raised, which could again impact the currency rate. Same way, any war, rebellion, coup, or economic or any kind of external instability could lead to changes in currency rates. Same way, economic instability can also lead to change in currency rates, or same way, political instability can also lead to change in currency rates. So you have to keep in mind political factors, economic factors, and as well as external factors that could have an impact on currency rates. What is VAR, value at risk? It is also called as VAR. Value at risk, VAR, measures the maximum possible loss of a portfolio or an investment or any kind of asset for which there is a data with respect to past losses, past returns, so on and so forth. So VAR, the concept is basically based on statistics. It takes past data and using normal distribution figures out what is the probable maximum loss given a specific confidence interval. So with certain percentage of probability, what is the maximum loss that can actually be incurred is computed. The formula for computing VAR is value of the portfolio into standard deviation in decimal points or percentage points, and the standard deviation is typically taken of the returns of that particular portfolio. They can be daily returns, monthly returns, weekly returns, whatever it is. There's a specific unit of time. You compute the returns for that unit of time, and for those returns you compute the standard deviation. That standard deviation you multiply with the value of the portfolio, and then you multiply with the Z-score value, which basically gives you the confidence level, or at what confidence level you are trying to arrive at the maximum loss. So Z-score value at 99% confidence could be 2.33, right? So you multiply with that, and finally you multiply it with the time for which you're trying to figure out the maximum loss. So you don't directly multiply with the time, but you actually take under root of time. So if you're trying to find out the maximum possible loss over a period of 10 days, and the standard deviation is also a daily standard deviation, then you do portfolio value into daily standard deviation in percentage points, multiply with the Z-score. If it is at 99%, 2.33, multiply that with under root of 10. So this is how you actually compute VAR, which is value at risk, which gives you the maximum possible loss for a given level of confidence or probability. What are applications of VAR? VAR can actually be used to set trading limits. It can be used to set risk limits. It can be used to do asset liability management. It can be used to define exposures. So you can do a variety of things to ensure that your maximum possible loss is limited. This maximum possible loss can be distributed among people, and you can set trading limits to individual traders in your organization or individual people who are exposed to varieties of risks in your organization. What are the characteristics of VAR? VAR is based on historical data. It follows normal distribution. It is an approximate method. It is based on certain confidence level or probability. It uses, as I said, normal distribution, and hence a Z-score is considered. How do various stakeholders view risk? You have the equity and debt financials, you have the company, and you have the government. The equity and debt financials, equity investors are more bothered about if there is too much debt, then they will have very little value in times of liquidation. Same way, even the debt financials are concerned that there is too much debt in a company, there may not be any money left within the organization, and it is exposed to too much of risk, or debt lender or the lenders are taking too much of the risk that equity financials are supposed to take. So both equity as well as debt folks are always concerned about the debt equity ratio, or the structure, debt equity mix that is there in an organization. Same way, as it comes to the company, when the company is concerned about the debt equity structure, whether the company will sustain, whether it will be a going concern, or there are any fears of liquidation. And this can be not only due to debt equity structure or a capital structure, but can also be due to a variety of risks that we discussed about. So you'll always evaluate risk, you will monitor risk, you will set risk limits, you will continuously look at risk and take mitigating actions that are required to ensure that the risks are always kept at minimum. How does the government evaluate the risk? The government always looks at risk from potential economic issues as well as potential social or labor issues. Economic issues, let's say when Lehman Brothers collapsed, there was an impact on the entire global economy. Same way, if let's say a large manufacturing unit shuts down due to some unfortunate, unforeseen loss event or unforeseen risk that came about, then there would be a lot of people who would be left unemployed. So the government always tries to monitor, or always tries to have a look at how companies, organizations are managing the risk, and how it in turn impacts the overall economy or the society at large.